Hello and welcome to another video from AMG Wealth Management. Today we're going to be looking at behavioural finance. And this is a really interesting topic for us as advisors for the following reasons. It's focused around the brain, which is an interesting topic in itself. And a lot of the issues that we deal with when it comes to finance are generally motivated on the issue of emotions. Now our job and the skill of an advisor is to pick out the emotion and try and apply some logic to the scenarios that we're facing. Now some of these concepts that I'll talk to you about today also reflect on day-to-day life, and I'm sure a number of you will also have these biases as well. The first one I want to look at is loss aversion. Now surprisingly, I've not had anybody come into the office yet to say, Phil, one of the things I really enjoy doing is I like to lose money. Not seen it, not heard it before. And no surprise, nobody really wants to lose money. But people sometimes forget, they forget the gains that they have and outweigh that against the potential losses. You've got to remember, with an investment, you do have the ups and downs that are just happening on a day-to-day life. However, the gain of £1,000, for example, is largely outweighed by a loss of £200. And people would see the loss as a bigger issue than actually the gain and the joy of actually having £1,000 in their returns. So it can lead to a tendency for investors to favour investments with limited downsides because of the fear of the loss that they may realise. And we've also got to remember that these losses are only paper losses. They're not actually realised until there was an encashment. So it also leads to people being reluctant to actually realise their losses. And what I mean by that is, as the stock market has been quite volatile since the COVID outbreak, people are waiting and sitting on the shares that they currently own, waiting for them to return back to their original position, before they then say, right, I'm going to move these and sell them on because I haven't made a loss. However, it might be easier, better, quicker to sell at a loss, reinvest the money that we've got, and actually return the gain in a different investment, because possibly the investment we've got isn't ever going to get back to our original and our hopeful destination. Our next concept is this hindsight bias, whereby we have the aha moment, and we've all done this, whether or not it's just in, like I say, day-to-day life, whereby I knew that was going to happen. If only I was going to put a bet on, for example, this team or a horse winning a certain race. We always have that I told you so moment, and that can lead to problems when it does come to investments. Now you may have seen in the office, Gary and I have a crystal ball. On the crystal ball it says out of order, and it's never worked. So what we have to do is make sure that we diversify our assets and our investments to make sure we limit the downturns in our investments. So this hindsight basis is always a really difficult one because most people seem to be able to predict the future. Another interesting one is anchoring. Now anchoring we do actually do in most of our day-to-day lives. So for example, I cycle into work. Now I know that if I leave at 10 to 8, I'm likely to be at work for past. And I've fixated on that time of when I need to leave the house. Any earlier, I am early. If I'm late though and I leave at 8 o'clock, in my head I'm now late for the time that I wanted to leave at. And that's quite dangerous, especially when it comes to investments or the price of goods or anything we're buying. We get fixated on a specific figure. So whether or not people are anchored to a price, for example, of the cost of a holiday, the cost of a drink out, these prices will go up. So whereby we might have someone who's willing to pay more for the price of the goods, that's only reflective of actually the value that's there. Maybe we've actually had these goods at a discount over the past number of years. So it's been reflective of that actually we anchor quite a lot in terms of our position and our general life in society. Overconfidence. Many people believe that they have got greater powers than potentially they have, and especially in the investment world. And what we do is when we do overestimate our own ability, it usually leads to us wanting to invest more, which is dangerous. Because essentially we need to know the stocks that we're holding, why we pick them, and essentially what we end up doing is forgetting the bad times and actually overcompensating by investing more. So overconfidence is quite dangerous because it does lead to that over-investment, which you need to be rather mindful of. One thing I know that I definitely do, and this is mental accounting. So I do have pots of money which are there for a specific purpose. And I've ring-fenced those pots within my lifestyle so that I know that I've got my holiday pot, my savings pot, my emergency pot, my home improvement pot. Now, when it comes to investors, they're no different. But sometimes we may even choose to only take income from an investment rather than capital. And actually, it might not make any difference. So, because we've mentally accounted for how we're going to use that specific pot, that's how we then intend to do it. But it might not be the right way. And again, that's where having the advice is key, because we will look at it from a different angle. Maybe a more efficient, better use and a better sustainable approach with your income and capital funds. So mental accounting is something that I know that a lot of people do on that day-to-day basis. The penultimate concept that we're looking at is the misunderstanding of probability. The Americans coin this the picking up the nickels in front of the steamroller. So it's this probability of something happening which people would focus on because they would look at it in absolute terms. I have new clients come to see me. They've not invested before, and a question that I often get asked is, could I lose all of my investment? Well, the reality is, yes, you could. However, that would probably mean that the world is imploded and there are no companies operating at all across the globe. So people sometimes will think in that absolute term, and they'll think of the worst possible scenario without considering what is the usual scenario. So for example, in that case I've just explained, it's looking at the low probability of a high impact and a high loss versus actually what tends to happen on a normal basis, which is the high probability of moderate returns. And that's where people should tend to be focused on. Our final concept is herding, the herding mentality, when people tend to follow a crowd rather than good advice. They hear someone has done well and they decide to do that themselves. However, it's the fear of missing out, and it's also through the lack of thorough research. And I've underlined thorough there because that's really key. A lot of the times when we see specific investment companies themselves to invest in, we only tend to see the headline detail, or maybe we just even invest in them because of their name. However, what we need to know is the detail that sits behind that to ensure that we're actually doing the right thing. Now, with all these concepts, if you discover that you've actually got 2 or 3 of them, that's fine. It's normal. Like I say, I have got this across my life as well, not just in an investment proposition, but also, like I say, in that general day-to-day life. Our job and the skill of an advisor to help you is just to be able to understand these at the times really when markets get choppy, a little bit volatile, and maybe our emotions act for us. Thanks for watching. Look forward to seeing you soon.